All right, so the first thing I want to cover is why people sign up for cash basis reporting. The primary use case is the customer's going to use accrual accounting, but they have taxes and tax law that lets them report taxes on a cash basis. So you'll have them running, accrual accounting, but then they use cash basis to report on their tax forms. The other one that we run into occasionally is customer has multiple entities. They have a headquarters, and then maybe they have, a smaller organization that they can use cash basis for in a second company. So that's another one we've seen. Originally, the cash basis reporting was important for property management. In addition to seeing their current cash position, there's some operational things that go along with property management that cash basis reporting helps for.
Typically, the customers who we see who are allowed to report cash basis are going to be your service type organizations. Property management, given that it's a service type organization and the entities tend to be, while they might be big in dollars, they tend to be small entities. Almost, I'd say, 99, if not 100% of property management companies do report for tax purposes on cash basis. And it's just based on the nature of the beast. So like we have CPA firms that use Acumatica that need cash basis. Typically you're looking at service type organizations. Small construction companies sometimes report cash basis. It just depends on the organization themselves.
And there's some rules in the US about who's allowed to use cash basis. If you reach a certain revenue threshold per year, you're not eligible to do it. And the other one that is not eligible is anybody who manages inventory in a warehouse is basically not allowed to use cash basis. So it's service related businesses primarily. Okay, this fourth bullet's also important. Every once in a while, we get QuickBooks customers who have been doing cash reporting. And the reason they migrate to Acumatica is because, after running a cash ledger and going back in time and mysteriously changing things, they get an audit firm or want to raise money from a venture capital firm or something like that. And they tell them, your hodgepodge, non-accurate reporting in QuickBooks isn't going to hold up if we're going to be investing in you. So occasionally, but they'll want to maintain a cash ledger just so they can do a year-over-year comparison for the first couple of years that they're on Acumatica doing accrual accounting.
But I also believe payroll transactions, because they create a GL entry, are able to be converted as well.
This was the original strategy, when you communicate it to potential clients. So we're in accrual. All transactions immediately show up there. But then we have the ability to run this cash conversion process to a separate cash ledger. The strategy is important in terms of Acumatica. So everything from GLA, R, and AP piles into this accrual ledger. And then we have a process that runs that takes these accrual entries and moves them over to a separate cash ledger. So also within GL, you can do it immediately. There's a create cash basis button on GL on the journal entries. And then there's the run cash conversion process, which can operate in the background. And it uses these the clearing account maps and the cash conversion map to make sure that entries are done properly. Now, once that's done, you basically have corresponding ledgers. You have a cash ledger and an accrual ledger. And the way Acumatica financial reports are written, it allows you to pick the ledger on the very first screen. So then you can run without changing financial reports and without writing new financial reports and everything else. You can then basically run it. We're going to talk about a couple scenarios here. We're going to talk about a revenue scenario, and then we're going to talk about a payables scenario as well. So basically it repeats the same thing I went here. If we get an AR invoice in and we release it, this is what's going on in the accrual ledger. When we hit the release button, the release in Acumatica terminology means post to GL, if that sometimes confuses people from legacy systems, but that's what that means. So then you get an accounts receivable entry and generally a sales revenue. That doesn't necessarily, I mean, this can be, modified according to what they want, but in general, that's the point. At this point, if you run a cash conversion, nothing's going to happen because receivables don't generate cash, and neither. So there's really nothing that's going to have to be converted. There's no cash transaction that takes place there. Then comes the payment. So when you collect the payment for the invoice, once again, when you enter the payment that you've received, nothing happens. But as soon as you hit the release button, it does this guy where it, puts the cash into your checking account and backs out the receivables. At that point, that's when the cash conversion process, when it's run, will then make the entry that basically you see here.
From a high level standpoint, cash conversion happens at the time cash happens. So when we receive the payment from the customer, when we pay the vendor, really anything that would run through cash, whether it's a prepayment on the customer side, a prepayment on the vendor side, an open payment. So I go out and I put the payment in, but I don't apply it against any open invoices. All of those will be eligible to be converted because cash has transacted.
Yeah, these first few slides are the ideas to present these to the let's call it the CFO, the Chief Financial Officer, who's thinking about buying the product, or maybe the corporate controller, but generally even he's going to want something more detailed. And then after you've kind of warmed that guy up, he leaves the room, and then the accountants come in, and then you got to do the demo. This particular transaction, this shows the resulting transactions of both the cash and accrual and how they match up. This arrow probably should have been bidirectional, but you get the idea. One links to the other, and there's what happened as a result of doing this transaction. This one I'm going to fly through because it's basically a very similar process, except it's on the accounts payable side. So you're going to go through and, enter a bill from a vendor, release the bill, nothing happens in the cash ledger, pay the bill, release the payment, and then at that point, it's an actual cash transaction at that time, so something happens. It's pretty similar. And then the other types of transaction are the journal transaction, where there's this button that allows you to create a cash basis on the fly. So that's a normally you would run a process that would do it, but this gives you the option to individually select certain transactions that you want to go in and produce a transaction for immediately.
Typically, this create cash basis button would be for transactions that were not affecting cash. So let's say, we had a major issue with classifying AP bills this month, and we, instead of going in and reclassifying 15 different AP bills, I just want to make an entry to move it from expense account A to expense account B or sub account or whatever it might be. If I made that entry and I also need it to affect cash basis, that because it does not affect cash, it would never show up in that cash conversion process. So I have the ability to push that entry also to cash basis by hitting that button.
There's a couple of different mapping things that you set up prior. It's part of the implementation process.
So what the whole point of this cash conversion mapping is to deal with things that would typically hit the balance sheet that would not exist cash basis that I need to map to a P&L account. So think along the lines of, and we'll kind of talk through what these examples are, but if you just sort of think about the fact that, when I put in an AP bill, I might code that to a prepaid expense, but prepaids don't exist cash basis. So when I convert that transaction from accrual to cash, I need to put that to an expense account. So typically this cash conversion mapping is dealing with transactions that accrual basis would typically hit the balance sheet that now I need to code to the P&L. So I always think of this mapping table as kind of like a find and replace in Excel. So when we're doing the cash conversion, we look at this table. If we're converting, let's say, an AR transaction, looking at that little screenshot that Doug has on the right, and I see that it's an AR transaction, I look at this and say, okay, is this account involved in this transaction? If so, don't use that. Use the one to the right. So it's like a find and replace. But typically what we're running into, or why this exists, is because we'd be creating transactions that would be affecting the balance sheet. That cash basis we need to affect the P&L. So kind of like that first example there, overpayment of AR. So if a customer accrual basis overpays me on the receivables, so even if they give me an extra dollar or they give me an extra $1,000 or whatever that might be, and it might be overpayment or just completely unapplied payments. So I might, the customer may send me $10,000 and I can't figure out how to apply it, but I want to go ahead and release that transaction. I want it to affect my ledger. I want to show it in cash, and I want it to show as a offset to receivables. That would be affecting AR cash basis. Accrual basis. And AR doesn't exist cash basis, so I need to map that to a revenue account. So I would need to say, okay, when the customer gives me money and I don't fully apply it, where do I want that to go on the P&L? That's what the whole point of this is. And we get into a lot of discussion with this in the implementation process when we're, walking through what situations do you have or not have. Because again, some customers typically will, overpay depending on what world you're in, or, in construction, for example, a lot of times you might get over and under payments, but at the end of the day, it equals your contract amount. But over time, based on their system rounding, they might overpay you $1 and then on the next pay up underpay you $1. Well, we need this overpayment to go somewhere. And so, because we received that cash, so I need the other side to go on my P&L somewhere. And that's what this is about.
So you collect the cash, and basically this column here is a best guess as to where it's going to end up. In some cases, it may be better than a guess. You may actually have a specific account for a specific thing. But then when you actually make the application, nothing's going to happen, but you kind of have to keep your eye on it.
So it depends on what your situation is. So a lot of times we'll, in the implementation process, as we talk about these things, if the customer has one revenue account, great. We know where to put that. If they have 15 revenue accounts, then we don't know where that overpayment should necessarily go. So a lot of times we'll create a cash basis, customer overpayment revenue account. And when we convert it, we have it hit that bucket, so we're able to move it appropriately. We do what we can with that, but at least it gets it off of the balance sheet. Because with QuickBooks doesn't do actually cash basis. A lot of times when I would pull a cash basis trial balance, there would be AR and AP on it. QuickBooks does a semi-modified cash basis, but they don't have this sort of intelligence built in to say, hey, customer overpaid me, or customer gave me money and I didn't apply it anywhere. They're just going to throw it to AR. And we're at least saying, hey, we recognize that this does not belong on the balance sheet. Where do you want to put it on the P&L? And that's essentially what the cash conversion mapping does, is says, okay, let's take the other side of this entry from cash that would be hitting the balance sheet, and let's put it somewhere on the P&L. And you tell us in what scenarios. So when it's an AR transaction or when it's an AP transaction, this is what you need to do with it. The other thing that you don't have listed on here that is a required mapping is sales tax payable. So we would have to deal with where do we want that to go. And there's some various thoughts on whether we keep that in the liabilities or whether we put it into put it onto the P&L. But they have options.
All right, and then there's one more kind of table that you set up in advance, and this is the clearing account. So this one's a little more straightforward. In accrual accounting, some of your cash accounts, you receive cash into a clearing account, and then it sits there until you reconcile that with your bank transactions that then come through. If that process spans periods of time, then it's kind of expected that when you actually receive the cash is when you would report it. If the clearing account and the cash account clear, like if you clear everything on the same week or before you produce any financial reports, it's not as much of a concern.
Right. So the reason why this clearing account mapping exists is because we only convert the transaction at the AR, at the cash receipt on the AR side. So that would go into that clearing account. We do not convert the bank deposits, which would be the second piece of this transaction, which would move it from the clearing account to the actual checking account or whatever bank account that we put that money into. So that is why this clearing account mapping comes into play, because we don't deal with the second piece of the transaction, because there's no, and we'll get as we talk through how the mechanism of what happens behind the scenes when I run this, there isn't a way to say, okay, well, I'm dealing with this AR transaction, but it had a bank deposit over here, and now I got to look at that. There would be just way too much confusion. So if you're using clearing accounts on the receivable side, which I'd say 99% of our customers do, just to make the bank reconciliation process easier, then when we convert that transaction from accrual to cash, we need to know what cash account ultimately is that ending up in. And typically you have that situation where you have a one-to-one, where I've got a clearing account that maps to a specific cash account.
So then when it comes into the clearing account, or the cash transaction is converted at that point.
Yes.
But without this mapping, you don't know which proper cash account to map it to?
Correct, because because in the conversion process, it will recognize that that's a clearing account, and it's going to look to this table to say, okay, where ultimately is this money going to end up? And again, the assumption is on the accrual side that you will have deposited that money to the appropriate cash account, in that financial period.
So in theory, if there is a clearing account for each cash account, then the system could figure this out. But in Acumatica, I guess you can have a single clearing account for multiple cash accounts, which is...
You absolutely can, and one of our customers does that. Because if it was a one-to-one only, then yes. But it could be a one-to-many situation where you have one clearing account that goes to multiple different GL accounts. I don't recommend it. It's messy. That wouldn't be my recommended setup. But yes, you could certainly do that. But this is how we would try to force that to where it needs to go.
So that's the extent of kind of the original preamble.